Welcome back to the show. Today, we're diving deep into what's been called the dumbest trade war in the history of this country. Millions risked losing jobs and retirement stability as tariffs took center stage. Dr. Robinson, how did this trade war differ from past economic conflicts?
Great question. Unlike prior disputes, the Trump administration escalated tariffs rapidly and broadly, targeting core trading partners. According to the Peterson Institute, over $500 billion in goods faced new duties. This scale was unique, risking broad collateral damage to both American consumers and exporters.
And yet, the administration maintained that tariffs would bring jobs and investment. Critics predicted disaster. How did expectations shape public perception in those early months?
Expectations were shaped by decades of economic orthodoxy. Tariffs raise prices, kill jobs, and shrink GDP. But Trump's team argued that global supply chains would adapt, foreign producers would absorb costs, and U.S. businesses would benefit from new protections. It was a bold break from consensus.
Let's transition to inflation. Mainstream economists warned that tariffs would drive consumer prices sky high, but months passed without the predicted surge. What explains this apparent disconnect?
Theories abounded. Some analysts cite currency movements. As tariffs hit, the Chinese yuan and other currencies weakened, offsetting cost increases. Others point to global overcapacity in manufacturing, keeping prices low. The Federal Reserve Bank of San Francisco, for example, found that tariffs raised prices only marginally, about 0.3%, far below predictions.
So, some saw a boy who cried wolf scenario developing. Did this undermine the credibility of economic forecasting?
Absolutely. When inflation failed to materialize on schedule, critics of the tariffs lost leverage. The narrative shifted to questioning the expertise and even motives of central bankers like Jerome Powell, with some accusing him of acting politically rather than objectively.
Speaking of Jerome Powell, he's faced intense scrutiny for holding interest rates steady despite falling inflation. Some say he's acting out of partisanship or outdated economic dogma. How much power does the Fed really have over inflation in this context?
While the Fed can influence demand through rate changes, it's less effective against supply-driven phenomena like tariffs. Historically, the Fed's tools mostly controlling the cost of borrowing work best on inflation caused by overheated demand, not international trade disruptions. Yet Powell's cautious approach reflected both traditional thinking and an aversion to being seen as political.
Could his reluctance to cut rates, despite low inflation, have contributed to stagnation or recessionary risks?
There's evidence supporting that. The National Association of Home Builders reported a 13% decline in home sales, citing high borrowing costs. Critics argue that, with no inflation threat, lower rates could have spurred more growth and investment.
Let's dig deeper into tariff mechanics. The textbook model says tariffs are a tax on consumers, yet import prices actually dropped. How do we explain this counterintuitive outcome?
It's a fascinating puzzle. In practice, many exporters, especially in China, cut their prices to remain competitive, eating the cost of tariffs. A 2023 study by the Council of Economic Advisors found import prices for tariffed goods declined 2.7%, contradicting the tariff inflation narrative. This highlights how market dynamics can trump simple theory.
Does this mean the traditional models are obsolete, or do they require nuance in a globalized economy?
Nuance is key. While the basic logic of tariffs remains, global supply chain flexibility, currency adjustments, and foreign pricing power can dramatically alter outcomes. It's a reminder that real-world economics is more complex than any textbook.
Interest rates have come up repeatedly. With home sales stagnating and credit tightening, some blame Powell's Fed for economic drag. What are the broader ramifications for American households and businesses?
Higher rates ripple through the economy. Homeowners face steeper mortgage bills, businesses see costlier loans, and federal debt service balloons, costing taxpayers an estimated $400 billion annually. The Urban Institute estimates that first-time homebuyer participation dropped 8% since the last rate hike, underscoring the impact on everyday Americans.
Are there international parallels, or is the U.S. out of step with global trends?
Many developed nations, like Japan and the EU, cut rates aggressively after 2020. Japan, for instance, kept rates near zero despite higher inflation, prioritizing growth. The U.S.'s more cautious stance is increasingly isolated, fueling calls for a policy shift.
The debate has gotten personal, with Trump publicly urging Powell to resign and alleging partisan motives. How rare is this level of political heat on the Fed chair, and what are the risks?
Such public confrontations are unusual but not unprecedented. The most famous was Nixon pressuring Arthur Burns in the 1970s, which contributed to runaway inflation. Central bank independence is a cornerstone of economic stability. Politicizing the Fed risks eroding market confidence and potentially triggering volatility or higher long-term borrowing costs.
Do you see signs that these attacks are affecting Fed policy or credibility?
While Powell has maintained a steady course, persistent attacks can create an appearance of vulnerability. Investor surveys by Bloomberg show a gradual uptick in uncertainty over Fed moves, which could translate into market jitters if the pattern continues.
Switching gears, let's talk energy and geopolitics. Trump long warned Germany about its dependence on Russian gas, and now the U.S. has become Germany's top supplier of liquefied natural gas. What's the significance of this shift?
It's a landmark change. For years, over 60% of Germany's gas imports came from Russia, raising strategic vulnerabilities. The U.S.-Germany LNG deal, brokered after years of pressure, not only boosts American exports but recalibrates NATO's energy balance. According to the International Energy Agency, U.S. LNG shipments to Europe quadrupled in 2 years, reducing Russia's leverage.
Does this vindicate Trump's warnings about energy security, or are there caveats?
It certainly vindicates his concerns, but the transition is costly. German energy prices have risen, sparking domestic protests. However, the new arrangement strengthens Western unity against Russian aggression, a trade-off most policymakers now accept.
One of the most striking recent statistics: American-born workers gained 2 million jobs since January, while foreign-born employment fell by over 500,000. What's driving this reversal?
Tighter immigration policies and robust job growth are central. The Bureau of Labor Statistics attributes much of the gain to construction, manufacturing, and logistics sectors historically reliant on immigrant labor. Deportations and stricter visa enforcement have shifted opportunities to native-born workers, challenging the long-held belief that Americans won't take certain jobs.
Are there signs this shift is sustainable? Or could labor shortages become a new risk?
There's a risk of shortages, especially in agriculture and hospitality. However, the rapid uptick in native-born applications after ICE raids like the Omaha meatpacking case suggests Americans will fill jobs when wages and conditions are reasonable. The long-term sustainability will depend on training and wage competitiveness.
Zooming out, these developments challenge the decades-old consensus that free trade and open borders are always good for prosperity. Is it time to rethink how we measure economic success?
Absolutely. GDP growth and aggregate productivity often conceal distributional effects. A 2022 Brookings report found that wage gains during the last decade accrued disproportionately to the top 10%. Policies that boost headline numbers but leave middle and working-class Americans behind fuel public disillusionment and political upheaval, hence the populist backlash that propelled Trump's rise.
Should economic policy focus more on median incomes and job quality than abstract growth metrics?
Without a doubt, prosperity isn't just about totals, it's about who benefits. Countries like Denmark and Singapore tailor policy to raise living standards broadly, not just chase GDP. The U.S. debate is shifting in that direction, albeit slowly.
Finally, immigration remains fiercely debated. Many economists argue mass migration is vital for growth, but recent data suggest otherwise. How do we reconcile theory and reality in this area?
It's complicated. Immigrants fill key gaps and drive innovation, yet unregulated flows can depress wages for low and mid-skill workers. Recent job figures show that, with tighter borders, native-born workers are capturing more gains. The Council on Foreign Relations notes that the right balance depends on local labor market needs and broader social goals.
So, should the priority be maximizing GDP or ensuring citizens share equitably in economic gains?
Ultimately, a sustainable policy must reconcile both aims. ignoring citizen welfare courts' backlash, while ignoring growth risks, stagnation. The challenge is finding the right balanza debate that will define American politics for years to come.